Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. Thank you for joining us. My name is Robert Kuhn. I'm president and founder of Kuhn Capital Partners. We are independent. We are a registered investment advisory firm, and yes, we are a fiduciary. Hopefully this is not your first time listening to the show, but if it is, welcome. If you're listening on the podcast, welcome as well. We love the podcast. We love the podcast numbers, and so we do podcast every episode of the radio show. So with that being said, I want to thank everybody for joining us this week. News flash, markets go down. We have a lot to get to today. I always feel like my job is to try and convince, articulate, share strategies that individuals can implement before the markets go down. When we see market volatility like we have seen, inevitably our activity picks up greatly. For those that are calling in for the first time, we see a lot more of those individuals when we do our dinners, which we do have dinners starting next week and the following week in Naperville and in Oak Brook. We see that activity pick up. But if this is your first time listening to the show, know that we are a fiduciary. Know that we try to craft strategies that can do well in all markets. We believe in tax reduction, significant tax reduction, and obviously we do a tremendous amount of banknotes. And so with that being said, 630-492-1912, 630-492-1912 is the best way to get in touch with us. You could call Paige and or Jenny today or throughout the week and make sure that you reach out to them, and they will set up a time for us to have a conversation. So we love having those first calls. I get a lot of individuals from Central Illinois, really from Indiana, and obviously throughout the Chicago area. So our show is different. Sometimes when you have to say that, is it really different? But I think our show is different. Our job is for listeners to make sure that that you can include strategies that can do well, even if the markets are down. So we do a lot of banknotes. These banknotes are backed by the largest banks in the world: J.P. Morgan, Citibank, America, Morgan Stanley, etc. And they kind of, when the markets are down or markets are up 20%, 25%, you have a lot of, it only did 12, well, it only did 13. And when you craft portfolios, you have to always make sure that you are trying to figure out what that bucket of money, what that sleeve of money is there for. And so we are contingency planners. That's how we talk. That's how we like to express what it is that we do. Our job as money managers is to make sure that if the markets are down, that we still have something that can do well when the markets are up. So the banknote that we did last week, we priced it on one of the more volatile days, but 14.30. Think about that. 14.30. And you get those coupon payments paid monthly, so that's an annual number paid monthly, as long as the indexes are not down 30%. So we have a strategy that is going to pay you 14.30, not callable for 6 months, backed by the largest, most strongest credit banks in the world. 14.30. It's almost like I should just say that the whole radio show. 14.30 with 30% downside protection. And so, yes, if this is your first time, you can get monthly coupons in that one, 14.30 annual paid monthly, as long as the indexes that the note is tracking are not down 30%. So we get a ton of people calling for those, and I love it. Absolutely love it. And the beauty of those notes are when we started doing them in the early 2000s, late 90s, I think it was actually the early 2000s, in many instances, you needed a significant amount of money to participate in the notes, and so that's why a lot of advisors, unfortunately, didn't incorporate them in their plan of how they manage money for individuals. We did, and so it's second nature to us. And today, the minimum's $1,000. Now, I mean, we don't have a lot of $1,000 accounts, but that's the minimum. And so we have a lot of individuals who will have $500,000, million, $3 million, $5 million, $10 million, whatever, of investable assets. And the only thing they want to use us for are the banknotes. And we're okay with that. I mean, you're still going to get, to learn about everything that we do. But we're okay with that. I mean, we obviously charge an annual fee. So, whether you do 50,000 or 50 million, I mean, it's going to ultimately benefit us as well. But 14.30. And so, because I often hear, when you see the market, and we're going to give you a lot of market statistics today, we're going to talk a lot about, what has happened in the market. But unfortunately, bear markets happen more often than many realize. And most people don't really have a strategy in place to navigate multiple severe downturns during their investing years. And so, market volatility and losses when you are still contributing, when you still have cash flow coming in from employment, you sold a business, sold a building, whatever, they're not the end of the world, albeit, we would never just sit and take it like, most advisors recommend. But, that's another topic we'll probably get on, today. But when you look at how often bear markets happen, I think we have to really, really think about this, because if you're in your 50s or 60s or 70s or 80s, especially in your 50s and 60s, right? 50s, 60s, and early 70s, you are going to see significant volatility historically. Because when you look at the numbers, you guys can Google this. I mean, this is not, rocket science that I'm bringing to you or cutting edge data, but, the markets on average are down 20% every 4 years. And now this is going back to 1928. So pretty significant sample size. And I hesitate to use averages because I think that it gives individuals a false sense of hope. Because really you look at market averages, 125 years worth of data. What does that mean to somebody who is 5 years from retirement, 10 years from retirement, 15 years, from retirement, retired 10 years ago? I don't really think that 125 years worth of data means anything, because I can show you a 10 to 15 year period where, if you bought Microsoft, you didn't make any money. And that's not going back too far. That's just going back to the early 2000s. And that's what's wrong with this industry. The industry just simply relies on averages. And I guess my grandson and my granddaughter, who's, 2 and 4 months, I mean, maybe, 125 years worth of data could make some sense for them, but certainly not somebody in their 50s, 60s, and 70s. And so, on average, markets are down 25%, 16% of the time, so every 6 years, 30%, 11% of the time, so that's every 9 years, 40%, 7% of the time, so that's every 14 years, 50%, that's 5% of the time, that's every 19 years. So think about that. If we see a 30 to 50% correction, well, it's not if. I mean, it's going to happen at some point if history, repeats itself, which, the four most expensive words I think of investing is it's different this time. But what do you have in your portfolio that if we see a 30% correction, which happens one every 9 years, so if you're in retirement for 20 to 30 years, you're going to see 3 of those. I mean, you better start thinking about this stuff. You better start working with advisory firms, in my opinion, that can still deliver positive returns even in negative markets for some of your money. It's strategies that can greatly reduce your taxable income, strategies that, if you're a high wage earner, or you sold a business, sold a property, and you want to reduce your taxable income by $90,000 per $100,000 invested. Those strategies exist. And so I really want you to start to think of, and when you start to position, if you're managing the money or if you're working with somebody who is managing the money, the single most important question is, I know the markets don't go down all the time, and on average, they're up more than they're not. But what do we have in the portfolio that if, my plan, and it's probably not income necessarily, but it could be legacy, it could be, why just have that stress? And so when we look at what we're bringing to the table, strategies like the 14.3% banknote that we priced last week, that you're going to get that monthly coupon as long as the indexes aren't down 30%. I mean, and it's $1,000 minimum. I mean, it's like, come on. I mean, if the markets are down, I mean, look at what the markets did, the last week. I mean, it's an issue. It is a real issue. Things can get out of control quick. That's not my base case, but, again, we're contingency planners. We're risk managers, and that is the job, is what is your airbag? What is your airbag in your portfolio? And if you don't have one, if you can't readily point to it, then you don't have one. You just don't. Your airbag is, just time in the market and diversification, which simply means, you own stocks and bonds, and these asset allocated models are just absolutely crazy. In my opinion, in my belief, it's shocking to me. Why would you work with somebody to just simply have an asset allocated model when you can go and do that on your own? That's lazy, because, the current market mentality, here's the reality. CPI inflation is lower than expected. So generally, you sell stocks because we're entering a recession. If we have CPI inflation higher than expected, sell stocks because, rate cuts, potentially are off the table. And then you have CPI that is as expected, right? And then you sell stocks because inflation is not falling. So, I mean, sentiment and what is going on in the market is real. It is very, very real. And proactive investment, proactive risk management, strategies that are predefined. Risk, I mean, you get into an accident, right? When do you want the airbag? You want the airbag before the accident happens. It's just like investing. You want the strategies in place before the market goes down, because yes, nobody knows what's going to happen tomorrow. Absolutely nobody knows what's going to happen tomorrow. It's a pure guess. It's a pure hypothetical. It's a pure gut feel. And for those that are right 9 out of 10 times, the 10th time when they're wrong, it can kill you. And so when we see, the markets do what they did, I mean, this was the 5th fastest correction of 10% in history. 5th fastest correction of 10% in history. And so you have to look at how are we taking advantage of that. So here's how we're taking advantage of that. We have our banknote strategy, so still clipping coupons, even though the markets are down, as long as they're not down 30%. 14.3 was last week's pricing. The one before that was 13.5. Now again, those are really, really high. All right, generally they're between 11 and 12, sometimes 13%. But when you have volatility, and you have the relationships that we have in place, that we can strike and we can quote that note immediately and lock that note in literally on an hour time period when there's volatility, well, that's phenomenal. So if you want to take advantage of those, you got to get on that list now. You have to get on that list prior to market volatility, because we got to get the money in the Charles Schwab account. And so when we see maximum volatility like we did, and we can tell the bank that we can bring, $1 million, $3 million, $5 million, whatever that is, amongst one client or 100 clients, it doesn't matter. We're going to get the best pricing. And then when we can tell them to lock that in that day, that's when we get the best pricing. And these are the little things that you don't know. So if you want these banknotes, don't wait, because you're always going to miss it. Now, the next one, because we do so many, I mean, it could be high, it could be really good, or it could be a lower rate. But, if you want to get on the banknote kind of gravy train, as I call it, but it's, We have to open those accounts. We have to get that money funded and get that money in the Charles Schwab account, get it underneath our firm. If you have a Schwab account, you can move that money underneath our firm, and so we can manage it. But 630-492-1912, 630-492-1912. So give Paige a call. Let's have a conversation this week. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. Hopefully you know that if you've listened to this show. We're fiduciaries, we're risk managers, we're contingency planners. We want to include strategies in a portfolio before the markets go down that can still do well during down markets. It's really simple. When do you want the greatest technology in a car? When do you want to make sure that your airbags are not malfunctioning? I mean, this is basic stuff. It's before the accident happens. But when it comes to investing, unfortunately, most people don't think about risk until, the markets go down like they did, last week. And a lot of times, the markets are going to, you've probably heard the analogy, the markets stair step up and they elevator down. And so, we have the fifth fastest 10% correction in history. Fifth fastest 10% correction in history. So, a couple options. Sit and take it. Cool. I mean, if that's how you think you should manage money, then why are you working with an advisor? I mean, if the advisor's not bringing to the table strategies that can do well, why are you working with them? Think about that. Why? I want you to really think about that. If you're working with an advisor today, you must call them. You must text them. You must email them. And you need to ask, what predefined strategies do we have in place in the portfolio? It's really simple. What predefined strategies do we have in place in the portfolio? What does that mean? Like the banknotes. Last one we priced, 14.3%. Last week, 14.3%. As long as the indexes aren't down 30%, that is predefined. So my clients who invested in that note, they know it's backed by an A-plus credit-rated bank. Phenomenal bank. Again, we're only using the big ones, J.P. Morgan, Citigroup, Bank of America, BNP, etc. I mean, all of the big banks. And those investors, predefined, they know they're getting an annual coupon payment of 14.3%, broken down into monthly payments, as long as the index that note is tracking is not down 30%. You have 30% protection to make 14.3%. So for those investors who have missed it, I mean, let's not miss the next one. So 630-492-1912, 630-492-1912. And so that's the protected growth bucket. Ask your advisor if they have an investment that can reduce their taxable income by $70,000 to $90,000 per $100,000 invested. If you're accredited, $1 million net worth, not including your primary residence, $200,000 of income, individual, $300,000 of joint income. Again, Google accredited investor. If you meet that criteria, call your advisor, ask them what strategies do you have in place that can greatly reduce my taxable income to the tune of $70,000 to $90,000 per $100,000 invested in the energy space. If they don't have it, call us, 630-492-1912, 630-492-1912. We're going to have that conversation. We have to have that conversation. High wage earners, man, what are you leaving on the table? But we see far too many CPAs still suggest, don't convert to a Roth. Don't convert to a Roth right now. They're looking at it year over year. You look at, if you have a 7-figure IRA and you're in your 50s or 60s, those RMDs are going to be massive, that you're going to be forced to take out. The Roth conversion story on paper is still one of the best strategies that I've seen, especially for wealth transfer. But what if you had an investment? Because the downside is, yes, you get taxed in that year for the conversion. So if you convert $500,000, $500,000 of additional taxable income, okay, fine. But what if you had an investment that you could invest in that could greatly reduce or eliminate all of that additional income from the conversion? See, that is a proactive cutting edge strategy, a proactive cutting edge advisor. Those are the things. And again, I'm not saying it's for you. We have to do the math. But those are the strategies that we're bringing to the table that others aren't. And I encourage you to call your advisor and ask. And if they don't have them, why are you still working with them? I mean, seriously, this is your money. We're going through a period of time in history, possibly, of maximum chaos. Doesn't mean chaos is bad. Doesn't mean chaos, well, I mean, I don't know if chaos is good or bad, but generally it's not good. But it doesn't mean that the market is going to go down. I mean, we're not calling for, the world is coming to an end. I think volatility is going to be here. And think about this. When you have investment banks, very, very large investment banks, 3 of them right now that I know of that have called for under 2.5% a year annualized for the next 10 years. 2.5% annualized for the next 10 years. So a lot of maybe the easy money has been made. A lot of, the 20 to 30 to 40% are done. I mean, it's not impossible. Just go back to 2000, 2010. Market didn't do anything. You bought Microsoft in 2000. Took you 14 years to get back to even because the S&P has now fallen over 10% from its peak, which was February 19th. Can you believe that that's the biggest drawdown since 2022? 2022, it's just been really since 2008, but 2022, it's just been vertical for the most part. So, that's the 30th correction of 5% or more since 2009. And they do all seem like the end of the world. They absolutely do all seem like the end of the world. And it never is. It's never the end of the world, no matter what. It's not the end of the world. Now, it can feel like the end of the world, especially if you're in your 50s, 60s, and 70s, and you're not working with an advisor that has strategies that can actually benefit from that volatility. And that's what I was going to say earlier. And we'll talk about that here in a minute. But aggressive growth, I kind of forgot about that topic, but I want to talk about that here now. So when we look at volatility, the S&P 500 intra-year drawdowns, so that's from peak to trough, highest high to lowest low during the year, 1% happens every year. 5% happens on average 1.1 years, 10%, 1.6 years, 15% every 2.5 years. 30% every 10 years, 20% every 4 years. So you see significant intra-year volatility. So you see the markets go up, you see the markets go down. And it's, we look at, active management has all of a sudden got tagged as, well, you're trying to time the market. You're trying to, look at your crystal ball and guess what's going to happen tomorrow. There's a lot of people that can do that. I'm not one of them. And candidly, they don't need your money if they can. So, but when did active management really become tagged as a bad thing? It's not a bad thing. It is not a bad thing. That's what you want. You want active management. You want to be in something that is going to give you the best possibility of making money. The best possibility of making money. Yet, these advisors are still using these static asset allocation models, 40% equities, 30% bonds, 70-30, 60-40, what have you. That is not investing, in my opinion. That's not the most proactive way to invest. You're just simply along for that Wall Street roller coaster. And gosh, I hope that we're in a good period of time because you're leaving so much to chance. So our active strategy, our aggressive growth strategy, again, everything we do is third party, 100% third party. And when you look at our aggressive growth manager, they are 40% cash today, 40% cash. Now, I've heard all of the, they got to be right getting out. They got to be right going in, blah, blah, blah. Wall Street, that's what they do. That is what they do. Advisors, that is what they do with their money. They don't just sit and take it. They don't just have asset allocated models. I promise you that. More times than not, the advisor managing your money is going to manage their personal money different because they can't scale a business of real active management. They just can't do it. It's very, very hard to do. And so our aggressive growth strategy that we utilize third party on CNBC all the time. If you want to go direct, you got to give them $500,000. We can do it for $25,000. That strategy since 15 up almost 10 times. $100,000 is almost at $1 million since 2015 net of fees. The S&P 350, 360. Now that's past performance. Obviously, it's not indicative of future results. You don't invest solely based on, past performance. We still have to make sure it makes sense to you and how are you using it. It's phenomenal for Roth IRAs. It's almost average 25% a year. And here's the beauty of it. It's based on computers. It's based on mathematics. It's based on an algorithm. It's not a gut feel. So when you have gut feel money managers that make a good call here, they raise a ton of money and then never make another good call because it was gut feel. Well, this isn't gut feel. Doesn't mean the computers are always right. Don't get me wrong. Don't hear that. But we believe it's the most repeatable when you're using computers. And computers can see things that we can't see. 630-492-1912, 630-492-1912. So yeah, that's, again, we don't often talk about that aggressive strategy, but 40% cash right now. They have raised it. And I love the aggressive strategy that we utilize because it's a go anywhere manager. Go anywhere manager. They don't have a mandate. They can go long, they can go short, they can make money when the market's up, when the market's down. They don't have to stay with an asset class. They can go long bonds, short bonds, they can go long tech, short tech, they can do anything. Computer and momentum and money flows, in my opinion, drive the market. So why don't you have a strategy for some of your money like that? Put $100,000 in the last 10 years, it's almost at $1 million. Almost at $1 million. The S&P, 350. Past performance certainly doesn't mean anything about tomorrow. But why don't you have that, especially in your Roth IRA? Now, again, it's volatile, right? There's ups, there's downs, no doubt about it. But again, we don't have to tap that money to live on. Well, that's why it's only a 3 to 10% allocation of a portfolio. Because you look at Warren Buffett, right? Warren Buffett recently sold Apple at the top, had $300 billion in cash before the worst drawdown in several years at 94 years old. 94 years old. You look at Jamie Dimon. I don't know if Jamie Dimon sold, all that he sold in Chase stock because he thought the market was, going to crash. I have no idea, but he did sell. I think, it's reported at least $250 million, and he missed the downturn. So, actively strategically reallocating is not timing. But yet, all of a sudden, when you do that, it's a bad thing. Advisors are going to tell you it's a bad thing because they can't do it. And they just want you to sit and take losses because it's easy for them to go and scale their business to make more fees. We're not that way. 630-492-1912. 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. Thank you for listening. If this is your first time, welcome. Repeat listener, thank you very much. Send on the message, send on the podcast link, let someone know to listen. We love it. We're trying to get our message out. Well, we are always. We're very passionate about helping individuals not lose money unnecessarily. Strategies exist that are predefined. Strategies exist that can make money when the markets are down. And that is something that we're going to talk an awful lot about. We talk a lot about the banknotes. Last week, we priced one that happened to hit the volatility right at the perfect timing, 14.3%. 14.3% annually, paid monthly, as long as the indexes weren't down 30%. 14.3%, as long as the indexes weren't down 30%. How is that? How does that compare to a CD? How does that compare to a bond fund? Look at these bond funds today. pick your favorite bond fund. Just look at AGG. That's the AGG is the ETF, total, 10-year ag, Lehman, well, it was Lehman, Barclays Ag now. 10 years, number 1415. That, I mean, you're losing money after taxes and inflation. 1.5. I mean, you're tying your money up, and these advisors who use these asset allocated models are tying 30 to 40 to 50% of your money up in strategies in many instances that have averaged under 2%. That's where the banknotes come in. That's where the protected growth strategies come in. Again, you have to think about that. 14.3%, as long as the markets weren't down 30. That was the note that we priced. That is the note that investors were able to invest in. Now, if you want to get on the, and you want to think about investing in banknotes with us, you have to have the money at Charles Schwab when we price the note. So don't wait. Those people who got 14.3, they were people that are current clients and people from the radio show that have come in recently. So if you want to get on that list, if you think that a strategy that can pay double digits historically with 30% downside protection is an investment that you want to take advantage of, you have to either A, assign our firm to your Charles Schwab account. That's a simple form. That means we can just manage it. Very easy to do. Or you have to open an account at Schwab and we have to transfer money from other firms, other advisors, or you have to, fund the account somehow. So once that money's there, then you can start taking advantage of these notes, because we cannot allocate to you unless the money's in the account. And we will not go on the hook unless we see the money in the account, because the more that we can commit to the banks, the better yield we can get. And that is why people come to us for these strategies. We do these at scale, and everything we do is custom. We tell them what we want. They go, and then they come back and price it. Well, they price it and they come back with the yield. 14.3 A+ credit rated bank was the last one that we did, paid monthly as long as the coupons paid monthly, as long as the markets weren't down 30%. That is huge. So 630-492-1912. So I read an article this week, who's ready for an 80% decline? 80% decline, and not getting ready or getting back to where we were until the year 2040. Think about that. 80% decline, not getting back to where we were until 2040. Could it happen? Yeah, it could happen. Do I think it's going to happen? No, I don't think it's going to happen. But what do I know, right? I mean, the markets are going to do what the markets are going to do. But the reality is that, it could certainly happen. And we have to be very, very careful that if it's not, 40% or 80%, like this individual said, I think that's more for clicks. But what if it's 30 or 40, right? I mean, what if it's 30 or 40 and we went back to how often the markets drop? You're going to see 30% corrections, maybe 2 or 3 or 4 times in your retirement. And what does that do? What does that do to you mentally? What does that do to you psychologically? What does that do to the longevity of your portfolio? What does that do to, the stress that could incur, that if you have $500,000 or 10 million or whatever that number is, and you see the markets, cut your investments in half, how does that make you feel? Well, we know the answer is probably not good. So now is the time to prevent that, or to take action to limit that. 630-492-1912, 630-492-1912. I couldn't believe, we haven't had to read about market circuit breakers. And we dealt with these in 2008 a ton, less or so in the early 2000s. But most people listening probably don't, recognize or realize, what, circuit breakers are. And but there is circuit breakers that give the market time to breathe. And so, you're starting to see with the volatility that we saw last week, you're starting to see, more and more people talk about the circuit breakers. So I thought it'd be good to kind of share those with you, because many retail investors really, truly are facing their first potential bear market. And circuit breakers, again, are back in discussion. So the first circuit breaker, which they say is level 1, is if the benchmarks drop 7%. So if they drop 7%, and the drop occurs before 325, I believe it was Eastern, the market stops trading for 15 minutes. So 7% correction stops trading for 15 minutes. Now 7% on where the indexes are today, man, that's pretty hefty. Level 2, 13%. So 13% drop. The markets get another cooling off period of 15%. 20% drop. It's no matter when it happens during the day, the market is halted for the remainder of the day. And so, could it happen? I don't know. I mean, maybe. I mean, it certainly could happen. I mean, we see, so much of the market is concentrated in such a handful of names, and you have, tariffs, and, who knows whether, it's above my pay grade on what's going on with tariffs. But, a lot of people are starting to get nervous. And here's the news flash. The market, it didn't really drop a ton on a percentage basis. Not a ton on a percentage basis, even 10%. And you have stress and you have anxiety because you're not positioned correctly. We talk a lot about annuities, right? And how we don't like or don't find a use case, a mass use case for annuities that are that have the lifetime income. I mean, again, no annuity is going to guarantee walkaway money, 7% growth. I hear it all the time. Well, I'm guaranteed to grow 7%. No, you're not. Your income is, but not your real money. And the insurance companies know that you're going to, you're only taking, with those lifetime income annuities, you have to understand, you're only taking your own money out, your own money, until the account goes to zero. When the account goes to zero, then you're into the insurance company's pockets. Then the insurance company starts to pay you with their money. I would think that you would think, like me, that actuarially the insurance companies know that they're not going to do that, because they're going to give you just enough growth, and then they're going to limit your withdrawals. They're going to restrict how much money you can take, right? So you look at cash flow, and you can never buy an annuity based upon illustrations. I mean, these illustrations, the bulk of them are back tested. What does that mean? They didn't exist. They're going to show 10-year number, but they only existed for 1 or 2 years. I have a list, and it's updated monthly, of every single meaningful sub-account that is in the index annuities. Every single one. So if you look at an illustration and you see 18% growth, 20% growth, 13% growth, 40% growth, well, it's never happening. And let me send you the report so you could see what they did. The problem with these illustrations, I can't believe the industry still lets people look at back-tested hypothetical data that did not exist. And it sets individuals up for failure. But again, what do we use for that? Well, let's use the bank notes. If you really need cash flow, let's get double-digit cash flow with 30% protection. So, those are the things that we really, really want to talk about, and, that we're going to talk about when we meet. Again, it's all financial planning based. I mean, that is something that, we're very, very big believers in is making sure that, we have, financial planning in place. And we really want to talk about the tax reduction. And I don't talk about it enough on the radio, but we have dinners coming up in Naperville. I don't know if we're sold out yet or not, which we may be, but you can certainly get on the list for the next one. And we're doing dinners at Gibson's in Oak Brook. So if you're around those areas and you have $1 million net worth, not including your primary residence, or you make a couple $100,000 a year, then these dinners are for you, because we're going to talk a lot about tax strategies. We're going to talk a lot about strategies that can reduce your taxable income greatly, active or passive. I see far too much money going into multifamily real estate at these cap rates, at these cash flow yields of nothing, in my opinion, nothing, with very limited tax benefits. I mean, so we have to, again, our job is to just share the data, share the education, share with you what is out there, and then let you make a decision. So 630-492-1912, 630-492-1912. Call Paige or Jenny this week if you'd like to have a conversation. Get on our calendar. Inevitably, when the markets, do what they did, our activity, increases dramatically. And I want to make sure I'm doing my job. Don't let that happen before you act if you're not 100% certain that you have the best tax reduction strategy, the best cash flow strategy, and predefined investments inside your portfolio that can do well when the markets don't do well. Let's have that conversation. 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, President, Founder, Kuhn Capital Partners, independent registered investment advisory firm. Yes, we are a fiduciary. We do talk a lot about investments on the radio show. We do talk about strategies that others are not going to talk about on the radio. If you listen to the radio, most of the radio shows are just, it's my belief, because I'm in the industry and I know the shows and I know what other individuals are doing, that they're basically just annuity pitches wrapped up as money manager and money management pitches. That is not us. We encourage you to stay away from those one-trick ponies because it's just not objective enough. And that, to me, is very, very critical in the market that we're in today. So if you have any questions or concerns or thoughts of your current portfolio, if you want to learn more about what we're doing, just give Paige a call, Jenny a call, 630-492-1912, 630-492-1912. Set that call up and we'll have that conversation. We do have dinners in Naperville next week. The following week, we are in Oak Brook at Gibson's. These dinners are generally for accredited investors. So just Google accredited investor, not qualified purchaser, just accredited investor, and see if you meet that criteria. Then we'd love to, if we have space, we'd love to welcome you to the dinner. If we are full for these dinners, then you'll be first on the list for April's dinners. But we're going to go over strategies that, again, are predefined, like the most recent banknote that we priced, 14.3%. 14.3%. Yes, it's the highest that I've seen in years. So don't get used to that. Generally, it's 11, 12, maybe low 13s. But this one was 14.3% annual, paid monthly coupon payments each month as long as the indexes did not drop 30% or more. So another way to look at it, you have 30% downside protection to still deliver mid-double-digit returns. Goodness, I just can't even believe I was shocked. When I heard that rate, I immediately text our partners, and it's like, holy goodness, can you believe it? 14.3. So again, you have to be, money has to be here. We work through Charles Schwab. So Charles Schwab is what is called our custodian. So if you have a current account at Charles Schwab and you want us to manage that money, it's very simple. You just add us to that, and we can to your account. We can certainly help facilitate that with one signature. So that's very, very easy. If you have any interest in doing any of the notes down the road, always open the account at Schwab with us, with my team. They will do that. Get the account funded, whether you write a check or whether you transfer that money from another advisor, from another firm, if you're managing the money on your own. We do this all day, every day. Well, we do it a ton. I don't know if it's all day, every day, but you get the point. But we make it very, very simple. But we have to have that money here if you want to take advantage of these banknotes. And the banknotes are not callable for 6 months. So that means we're going to own them, worst case, we're going to own them for 6 months, and then they can be called. So it's a relatively shorter term investment. And so it's, again, double digits with 30% downside is just something that most people should have as a bond alternative. Because, again, these asset allocated models that the average advisor is doing, look at what you're doing in the bond space. Under 2% for AGG over the last 10 years, under 2%, actually 1.5%, 1.2, 1.3. 1.2 to 1.3 in the bond bucket is what the index has done. So, working with an advisor that simply has an asset allocated model, you're leaving so much money on the table, we believe. So 630-492-1912. And the dinners, we're back to doing them. We usually take off first part of the year. And tax planning is a year-round activity, all right? And many of you know that I am also the general partner of a energy fund, Bison 2 LP. And so third and fourth quarter, man, it is crazy, crazy busy for us because everybody starts to think about tax planning. Well, we are simply buying minority interests in majors projects, the Exxon, Chevrons, Conocos, Matadors, Occidentals of the world in the Permian Basin. And people selling those deals, they know that end of year, people want to place money. So do you think we're getting the best pricing towards the end of the year? Absolutely not. And so that's why we're doing all we can to acquire assets when it's, downtime, like right now. Because people aren't thinking about taxes. But, so those dinners, we're going to certainly talk a lot about that. We're going to talk a lot about the defined strategies, defined outcome strategies of the banknotes. And the Bison strategy, again, the target is $70,000 to $90,000 of tax benefits. So that means if you invest $100,000, if you invest $1 million, you can do the math. Target 70 to 90%. That's going to reduce your taxable income, active or passive, W-2, 1099. Now, again, we're not CPAs. I can't give tax advice. So we always encourage you, take what we say, bring it to your tax professional, get them to check the box that it is what it is. So those dinners, we're going to spend a lot of time on that. We're going to spend a lot of time on, the defined outcome strategies. We're going to talk about why you need an aggressive growth strategy in your portfolio, why it has to be tied to mathematical models, algorithms, rather than gut feels, the strategy that we utilize, that we have for years. Since 2015 has annualized almost 25% net of fees. So $100,000 is actually at almost $1 million, where the S&P is at around 380,000. Past performance doesn't mean anything about tomorrow. So again, it may make sense for you. It may not make sense for you, but why wouldn't you use that for a Roth? Why wouldn't you use that for 3 to 10% of your total portfolio? Put it into a Roth, use your Roth money and let it get after it. Again, it is when we look at, efficiencies, when we look at, where, we place, assets, there's nothing better than a high octane strategy for some of the money in a Roth. I mean, think about putting $100,000 in a Roth in 2015 and having that net of fees almost be over, close to $1 million. I mean, that's pretty darn good. You're not going to have to pay taxes on, in the Roth. So, those are the things that we're really trying to look at. Those are the things that we're trying to differentiate ourselves. You want protected growth. You want growth plus, and then you want tax and alternative. And those are the four strategies. Those are the four sleeves. Call them what you want, but they're independent of each other. They all serve a purpose in the portfolio. And it's a little bit better, a little bit more diversified, a little bit more structured, in my opinion, than just a 60-40, 70-30, 80-20 basic portfolio that your investment advisor dresses up as proprietary, dresses up as the best thing since sliced bread, but yet all they're doing is tracking the market up, tracking the market down. And I encourage you to be done with that. That is a dinosaur advisor, 630-492-1912. And I don't care how much the firm manages. I don't care if they manage 20 billion, 50 billion, 100 billion, 8 billion, 1 billion, 200 million. It does not matter. How much somebody manages is irrelevant to your performance. It's great for them. It's great for their revenue. And that's why you see generally these, 1 to 10 billion, $1 to $15 billion shops that just do nothing more than asset allocation. And in a lot of instances, it's proprietary money management, meaning they're not going to fire themselves, and the performance is under market performance. So in January, we talked a lot about shining the light on lack of performance, and we're still doing that. If you're working with another advisor, if you're working with another money manager, and you do not have strategies in place that can deliver positive returns in down markets to a point, then you're not working with the most cutting-edge advisor, and we have to talk. Allow us to stress test your portfolio, not our software, but we absorb the cost for what I believe to be the most proactive risk stress testing software that you're ever going to find. Let us do it for you. You have $500,000, you have 10 million, you have somewhere in between, and you want to see just what value your advisor is truly bringing to the table, we'll show you, and then you can decide. We'll just show you the data. It's not our job. We're not great salespeople. I mean, I stopped selling in my early 20s when I thought, it's all about education. Simply about education. Now, I'll talk about differences. I'll educate on different strategies. I will talk about that all day long, every day. And I will compare and contrast our 4-bucket strategy of protected growth, growth plus, tax, and alternative against your basic asset allocated model every day of the week. And my job is to point out the deficiencies of what could happen with your portfolio. The fact that if the markets do stay down, if the markets do only annualize, which many investment banks are starting to come out, 10-year numbers under 3%. I saw a massive fund company, and I'm not going to name the name, but you can do the research, massive no-load fund company, massive. There's only 2 out there, so I guess, you can pick which one you want. But their 50% base case for 10-year performance was under 3%. Under 3% over 10 years. I mean, what does that do to your portfolio? What does that do to your lifetime savings? What does that do to your legacy if you don't need the money? What does that do to your retirement? What does that do to you psychologically in retirement, that if you just happen to retire at the wrong time in a period of weakness in the market where we don't have 20 to 30 to 50% growth, what does that do to your lifestyle? So as contingency planners, as risk planners, as risk managers, making sure that we can still deliver. The target is always double digit returns. Target is double-digit returns, like the banknotes. Again, last one, 14.3%. You got paid that monthly coupon, 14.3 annual, as long as the indexes weren't down 30%. So those are the things that we're talking about. Those are the things when you can marry investments that are cutting edge, great tax reduction, strategies that can deliver returns independent of the market, along with the best, most proactive financial planning that you're going to find. We have something that's tough to beat. And that's why we're on the radio. That's why we do the dinners. We're very, very passionate about taking business away from advisors that do nothing more than asset allocated models. And there are so many of them out there. It is going to keep us busy, busier than I may like to be. But again, our job is to help individuals. You have $500,000, you have $250,000, you have 10 million, 20 million. It does not matter. You're going to get the same proprietary intellectual capital that we're bringing to all of our clients. So tax reduction, defined outcomes, dinners are coming up. I think Naperville is full, or will be full by the time the dinners come. But again, sometimes we have cancellations. So if you want to get on that list, certainly let us know. Oak Brook is not till the end of the month, so I do think there's still time at Gibson's in Oak Brook. But again, give Paige or Jenny a call. If you miss these, then we can certainly get you on for our April dinners. But we're doing 4 dinners a month, and we just love sharing the message. We love getting the message out. We love getting people to think about investing differently. Asset allocated models, my belief is that they're going to disappoint you? And more importantly, why would you work with somebody for something that you could do on your own? If that's what you want to do and you want a financial plan, we'll charge you $2,500 for the plan, for the allocation, and then you can go and implement it one time. If that's really what you want, we'll charge you $2,500 for that, and you can go and implement it. But again, I don't think that's the best way to manage money. So with that being said, hopefully you got something out of this week's show. We look forward to being back next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.